company final account, a chapter where you have diverse varieties of questions. You are going to study schedule 3 here, the format of balance sheet and P&L statement given in the Companies Act 2013. We are going to study how to give effect of assessment of taxation. You can say gross demand of taxation, gross liability for taxation. You will see effect of participating preference shares, provisions regarding utilization of reserves for declaration of dividend. You are going to see managerial remuneration provisions, even added in your syllabus before 3 attempts, right issue. So one by one topics we try to discuss out, try to sort it out and clear our revision part. Okay, I directly touch the right issue. You all know what is right issue. Shares offered by our company to existing shareholders for a price. It's not free, but it's a firm allotment that those who applied will definitely get the allotment of the shares. Now, how do we find out the value of right share? That is what is there in your question, in your syllabus. X right value, cum right value, and from that getting value of right. Okay, when we solve the sums, it is fully based on a formula. Look at the formula. Theoretical X right value of share. How to find X right value? Existing shares into cum right price. Cum right price means market price of the share operating before right offers, plus right shares into the issue price of the right shares divided by number of existing shares plus number of right issue. Something like a statistical formula. P1 Q1 plus P2 Q2 divided by Q1 plus Q2. That will give you X value of right, X right value, and then the value of right is nothing but cum right value minus X right value. Okay, we see in your textbook the question. Okay, here is question 9. Company offers new shares. The new shares are the right shares which company is offering to you. Company offers new shares of rupees 100 each at 25% premium. What do you mean by 25% premium? The issue price for the right is 125. The right issue is at 125. Premium to existing shareholders on 144 basis. That means if you have 4 shares, company will give you right entitlement of 1 share. Cum right market price of the share is 150. Calculate value of a right. What should be the X right market price of a share? First we calculate X right market price by applying this formula and then the value of right. Okay, let us apply theoretical X right value of the share. First one, existing shares. What are number of shares? 4. Ratio is 4:1, right students? 4 into what is cum right price? 150 plus right shares you get 1. What is issue price of right share? 125 upon number of existing shares 4 plus number of right shares 1. Simplifying that, so this is 600 plus 125 divided by 5. So that gives you rupees 145 per share. And then applying the formula. Value of right is cum right value. What is cum right value? 150 minus what is X right value? 145. So value of right is rupees 5 per share. Very simple, just application of formula and getting the answer. I just tell you one logic, students, for this particular sum. If Mr. X is an outsider who is not a shareholder, and if he wants to purchase one share under this right offer, how can he purchase that? By how much payment he will get? First of all, he is an outsider. So to get one share under right issue, he should have 4 entitlements with him. One entitlement is of 5 rupees. So outsider has to pay 5 into 4. Mr. X has to pay existing shareholder rupees 20 to get 4 entitlement from him. On the basis of 4 entitlement, Mr. X will apply to the company to get one right share. So one right share, and offer price of right issue is how much? 125. So he has to pay to existing shareholders 20. He has to pay to the company 125. What does it mean? How much total payment he is making? 145, and that is his fixed right. Anyone can ask you this kind of question, that how much one outsider should be ready to pay for one right issue. This is a calculation. You first have to get 4 entitlements, because ratio is 4:1. 4 entitlements, one entitlement is always 5, so 4 into 5, he has to pay 20 to the existing shareholder who is renouncing his rights. And on the basis of 4 entitlement, he will apply to the company, and to the company he has to pay 125, the offer. The total payment to be made is 140. That was the first variety of the company account, calculation of value of right issue. We take the next variety, managerial remuneration. Companies had prescribed some upper limits, ceiling you can say, for payment of managerial remuneration to existing managerial people, those who are at the helm of the affairs of the company. Director, managing director, whole-time director, part-time director, all. For this purpose, the companies are classified in 2 parts, those companies which are profit-making companies and those which are loss-making. For those which are profit-making, their managerial remuneration depends upon certain percentage of net profit. Section 197 and Section 198 of the Companies Act 2013 deals with it. Section 197 defines what is the limit, and Section 198 defines what is net profit for the purpose of managerial remuneration. Look at ceiling for the maximum remuneration in event of the profits, remuneration of a managing director. Look at the word given, a managing director. Okay, now when there is a single managing director, so when a single managing director, maximum 5% of net profit. Or a whole-time director or a manager. So for all these people, okay, what you get is maximum 5% of the net profit. Next is remuneration of more than one whole-time director or more than one managing director or whole-time director. Maximum it is 10% of the net profit. Altogether means total of all should be maximum 10%. Okay. Next one is the third variety. The third variety is remuneration of a part-time director. When there is no managing director or whole-time director, maximum 3% of net profit. When there is a managing director or whole-time director, maximum 1% of net profit. And lastly, it says overall manager means total of all shouldn't exceed 11% of net profit. All are based on net profit, so it's better. The Act defines now what is net profit. Look at the definition of net profit. Calculation of net profit for managerial remuneration. Section 198 formula. Gross profit, add any other revenue type income, all those we write in P&L credit, discount received, rent received, commission received, bad debt recovery, share transfer fee for a company, all that. Second, subsidies received from government. And third, revenue profit on sale of extras. What is revenue profit? Total profit minus capital profits. Do not add premium on issue of shares and debentures because it's a capital receipt. It doesn't form part of P&L account. Profit on reissue of forfeited share is capital reserve, and capital profit on sale of fixed asset. All are capital receipts which never goes to P&L. So three things added in GP, less all working charges. What do you mean by working charges? All the operating expenses, admin expenses, selling and distribution expenses, etc., etc. Donation to charitable funds under section 181, compensation for breach of contract, bad debts, director fees, business related taxes. The biggest example you can take is GST now. Depreciation, but depreciation as per schedule 2, section 123 of the Companies Act, and all accumulated losses, brought forward losses. So final total is net profit for the purpose of managerial remuneration. What should not be deducted? All non-working charges, means non-operating expenses, loss on sale of investment, loss on sale of fixed assets, all abnormal losses like loss by fire, theft, accident, strike, etc. cannot be deducted for section 198. RDD, RFDD. RDD stands for reserve for doubtful debts. RFDD stands for reserve for discount on debtors or any other ad hoc provision. In short, no provision and no reserves are allowed to be deducted. Directors' remuneration, because that we are trying to calculate. Provision for tax, depreciation as per books, if they are not as per schedule 2, it is section 123 and transferred to reserves. So those things will not be considered. So this was part 1, managerial remuneration when companies are earning profit. Okay, let's try to see a question on that and trying to understand how the impact will come of this question. Calculation of managerial remuneration when a company is earning profits. Let us try. We stay with question 6, managerial remuneration where company is earning profit. Following is P&L account of Mudra Limited for the year ended on 31st March 15. They have given you P&L, so we try to select those figures which are applicable, useful in section 198 formula to find out the profit. Start with the credit side. Gross profit, yes. Profit on forfeiture of shares, no, it's a capital receipt. Subsidy receipt from government, yes. Interest on investment is a revenue receipt. Share transfer fees also revenue receipt. Profit on sale of machinery, amount realized means selling price 55,000 and WDV 30,000. The selling price minus WDV 25,000 is total profit. We are not concerned with total profit, we are concerned with revenue profit. So pending. Next, the debit side. Administrative, selling and distribution expense, yes. Donation to charitable funds, yes. Directors fees, yes. Interest on debentures, yes. Compensation for breach of contract is a regular expense. Managerial remuneration, no, because that is what we are calculating. Depreciation on fixed asset will be acceptable only if it is as per schedule 2, section 123, pending. Bad debts, yes. RDD, no. Reserve for doubtful debts. Provision for taxation, no. Net profit is of no use to you. Additional information. Original cost of machinery sold was 40,000. Now cost is 40, selling price is 55. So selling price in excess of cost price is 15,000. So 15,000 is your capital profit. The total profit is 25,000. So out of 25,000, when you subtract 15,000 capital profit, what you get is something what you need for section 198, 10,000, which is our revenue profit. Depreciation on fixed assets as per Schedule 2 of the Companies Act was 575,345, whereas depreciation of the books is different. This depreciation cannot be taken. You are required to comment on the managerial remuneration in following situation. When there is only one whole-time director. So just now we have seen section 198 puts a max limit of 5%. There are two whole-time directors, so combinedly between them will be 10%. Two whole-time director, a part-time director and a manager. So total of all should not exceed 11. How to find net profit? You all know it. Already tick marked. GPU start plus all incomes of the credit minus all expenses of the debits. Whatever I did cross mark you shouldn't consider, others will consider. When you make all these total trends, your net profit comes to 14,777,883. Now on this net profit, you calculate 5%, 10% and 11%. This 5% will be 73,894. 10% is 14,777,888. And last 11% total will be 162,567. Okay, everyone. So that will be your section 198 and 197 when companies making profit managerial remuneration. You have to remember that formally, that step of section 198 prescribed by the companies. Okay, there was that variety where companies making a profit. How do you find an upper limit ceiling of managerial remuneration? We now see the opposite side. If company is loss making company, what are the rules for managerial remuneration in event of losses or inadequate profits? Schedule 5 part 2. If company has incurred losses or if profits are insufficient, then remuneration can be paid to managerial staff on the basis of effective capital. When company was making net profit, the base was net profit, section 198. Now when company is having losses, the base for classification is effective capital of the company as under effective capital and maximum yearly remuneration. If effective capital is negative or less than 5 CR, max you can pay 60 lakhs. If second slab 5 crore or more but less than 100 crores, 84 lakhs. 100 crores and above but less than 250 crores, 1 crore 20 lakhs. And the last limit, more than 250 crores effective capital, it is 1 crore 20 lakhs plus 0.01% of the effective capital in excess of 250. Then question definitely comes, sir, what is effective capital? How do you find effective capital? And effective capital can be found out in this way. Paid up share capital, that is equity share capital plus preference share capital, excluding share application money when allotment is not yet done. Add all reserves and surplus, excluding revaluation reserve. Add all long-term borrowings, less miscellaneous expenditures which are not written off like accumulated loss, and less investments held by a non-investment company. A company whose main objective is not to do investment. If it has done investment, Maruti Suzuki Limited, if they have done investment, it is called investment done by a non-investment company. You have to remember this thing very, very thoroughly as to how do you find the amount of effective capital, because on the basis of effective capital, we'll be able to decide how much will be maximum managerial remuneration. Balance sheet. Following is the extract of the balance sheet of X Limited. was obtained. Balance sheet extract as on 31st March 15. Liabilities, you have authorized capital 4,20,000, 14% preference shares of 100 each is 4 crore 20 lakhs. 2 lakh equity shares of 100 each is 2 crores. That's an authorized capital, not useful to us. Issued, subscribed and paid up capital 4,15,000, 14% preference share of 100 each. 1,20,000 equity shares of 100 each, 80 paid up. Then share suspense account, capital reserve 60% is revaluation reserves. Of course, we'll be concerned only with 40%. The 60% is not to be taken by you. Security premium, yes. 15% debentures, also yes. Long term borrowing. Public deposit is also long term borrowing. So we'll take 370, 6,50,000, this 50,000. Out of 2,50,000, we'll take only 40%. So that will be 1 lakh you will be taking. Then we'll be taking both paid up preference shares and paid up equity shares. Cash credit loans, no, because it's a short term borrowing. And sundry creditors also no, it's a short term borrowing. Assets, investment in shares and debentures, etc. That investment will be deducted if your company is a non-investment company. If the company is investment company, no effect. Profit and loss account, yes, has to be deducted. Preliminary expenses not written off has to be deducted. They both are fictitious assets. Share suspense account represents application money received on share allotment of which is not yet made. So this is share application money pending allotment, cannot be taken for effective capital. X Limited has been sustaining losses for past few years. X Limited has only one whole-time director. Clearly given, company has been sustaining losses for past few years. Find out how much remuneration X Limited can pay to its managerial person as per provisions of Part 2 of Schedule 6. Would your answer differ if X Limited is investment? Yeah, it can differ if because of that investment. The investment amount in our sum is how much? 75 lakhs. For investment company, we will not subtract 75 lakhs, but for non-investment company, we will subtract 75 lakhs. So, because of this difference of 75 lakhs, if the slab changes, like you know it very well, the slabs are up to 5 crores, then next slab, etc. If the slab changes, the managerial remuneration will change. Yeah, if the slab remains the same, that answer will not change. So here, while preparing solution, what you should do is big space particulars effective capital and then two columns. Column 1, if it is a investment company where you don't subtract 75 lakhs, and column 2, non-investment company where you subtract 75 lakhs. Get the total. Here, when you make the calculations, friends, the answer coming over to you will be for investment company, it will be, I say you two columns, investment company and non-investment company. You already wrote above what is to be added, what is to be deducted. Only care to be taken for investment company, that investment of 75 lakhs will not be deducted. For non-investment company, it will be deducted. When you will make calculations, students, your effective capital amount will come to 4 crore 90 lakhs 40,000 for non-investment company, because 75 lakhs investment should be deducted then. Here it will not be deducted. So we'll have a difference of 75 lakhs, 5 crore, 65 lakhs point. Of course, you can very well see, friends, the slab changes. The first slab is up to 5 crores, second slab is above 5 crores. Here, the answer is going to change. So, your maximum managerial remuneration should be here up to 60 lakhs, and here max you can pay an annual managerial remuneration of 84 lakhs. So that was the calculation where a company is suffering from losses, calculation of managerial remuneration. We take one more variety of company account, that is rules for payment of dividend. Now, when a company wants to pay dividend and company is not having sufficient profits, then company may plan to use its accumulated profits, we call it as reserves and surplus. And there is a limit that up to this limit only you can use accumulated past reserves and surplus for payment of dividend. The theory says normally dividend is paid out of current year's profits. But if current year's profits are insufficient, then it can be paid out of divisible profits lying with the company, provided following three conditions are satisfied. So all three conditions should get satisfied at a time. Dividend rate cannot exceed average rate of dividend for last 3 years. Divisible profits utilized should not exceed 10% of the paid up share capital plus divisible profits, that is free reserves. Divisible profit left over after such utilization should not fall below 15% of the paid up capital. You see a question number 5 in your textbook. Due to inadequacy of profits during the year ended 31st March 15, XYZ Limited proposes to declare 10% dividend out of general reserve. It is clearly given. It is to be declared out of general reserve. From the following particulars, ascertain amount that can be utilized from general reserve according to company's declaration of dividend out of reserves rule 2014. 17,509% preference shares of 100 each fully paid. 8 lakh equity shares of 10 each fully paid. General reserve on 1,414, capital reserve on 1,414. 1,414 is the opening balance, students. Revaluation reserve as such cannot be taken. Net profit of our current year, an average rate of dividend during last 3 years. Okay, so company is planning that we want to declare 10% dividend. Definitely 10% has to be equity dividend, because preference dividend is always fixed. Your profit available is 3 lakhs. Now from this 3 lakh rupees of profit, first of all dividend declared will be 9% on preferences, and then it will be 10% on equity. So your first job will be to find out the 3 lakh rupees profit of the current year, how much is falling short, which we are transferring or planning to use out of general reserve of 25 lakhs. See, if I calculate that, my profit is 3 lakhs minus preference dividend 9%. 9% of 17 lakh 50,000 is 157,500, and then minus 10% equity dividend of 80 lakhs will be 8 lakhs. So in short, what is shortage is 6 lakh 57,500, and this shortage we are planning to use out of general. Clear? Come on. Now, 3 conditions. What was condition number 1? Dividend rate cannot exceed dividend average rate of last 2 years. Our average rate given in the question is 12%, and we have declared dividend at 10%. Yes, our dividend rate is less than the average. So, right. Fulfilled condition. Condition number 2. What was our second condition, friends? Dividend profit utilized. What is utilized? 6,57,500 cannot exceed 10% of paid up capital and divisible profits. So let us calculate. How much is general reserve we are planning to use? 6,57,500, and that should not exceed 10% of what is our paid up capital, friends. Preference capital is 1750, equity capital is 80 lakhs, and one more, our free reserves are 25 lakhs, general reserve. So 25 lakhs out of here. So calculate that. 10% of 9750, this one 1 crore 22 lakh 50,000, 10% of that will be 12 lakh 25,000. Find out. Yes, general reserve what we are planning to use is 657,500, is definitely less than 10%. So even second condition is also fulfilled. Let's see the last condition. The last condition, it says the divisible profit which remains after utilization. Now see, our general reserve was 25 lakhs. Out of 25 lakhs, we are planning to use 657,500. What does this mean? The unused amount left after utilization is 1842,500. Question says that this 1842,500 should be at least 15% of paid up capital. Calculate. See, condition number 2, it is paid up capital plus free reserves. Condition 1 is only paid up capital. So make the difference very clear in your mind. There is 15% of preference capital 1750 plus 80 lakhs. So 15% of 97 lakh 50,000, and that amount 15% will be 14 lakh 62,500. Confirm now. Is our balance left after utilization is more than this 15% or not? Yes, sir. It's more than 15%. So even condition number 3 is also fulfilled. That means our company will be authorized to issue or declare a dividend after using it from general reserve, because our company has satisfied all the 3 conditions related. Okay, so that completes the variety, declaration of dividend. We take another variety, participating preferences. This question is asked by ICI in past papers twice or thrice. Articles of Association of S Limited provides the following: 20% of net profit of each year shall be transferred to reserve fund. An amount equal to 10% of equity dividend shall be kept aside for staff bonus. Means whatever you pay to equity holders at dividend, then 10% of that should go to staff for the bonus. Balance available for distribution shall be applied in paying 14% on cumulative preferences dividend, in paying 20% dividend on equity shares. 1/3 of the balance available as additional dividend on preference shares, that is that participating preference shares. that after giving 20% to equity shareholders, even if there is some profit left, that profit will be shared between equity and preference shareholders. One third going to preference shareholders and two third going to equity shareholders as equity dividend. A further condition was imposed by articles that balance carried forward shall be equal to, balance carried forward means closing balance of P&L of current year, which is brought forward as opening balance of next year, on preference shall be equal to 12% on preferences after making provision of 1, 2 and 3 mentioned above. Company has issued 13,000 14% participating preference shares of 100 each. That means our preference share capital is rupees 13 lakhs. 70,000 equity shares of 10 each fully paid. That means our equity share capital is 7 lakhs. Profit for the year 2012 was rupees 10 lakhs, current year's profit, and balance brought from previous year rupees 80,000. Provide rupees 31,000 for depreciation and rupees 80,000 for taxation before making any other appropriation. Calculate additional dividend on preference shares and equity shares. That 1/3 and 2/3 question tells you to calculate. Now our basic calculation goes as it is. Like, what is your net profit given? Net profit given is rupees 10 lakhs. Just write in the brief only so that you can get a basic guidelines, friends. Okay, the net profit is 10 lakhs. This net profit is subject to depreciation and provision for tax. My depreciation is 31,000 and my provision for taxation is 80,000. So when I subtract this, what I get is my net profit of current year. 8,89,000 is net profit after tax. You can call it as net profit of current year, 889. In that I will add opening balance of P&L account, that is balance brought forward is 80,000, right? From that 80,000 I subtract the closing balance required. What is question saying you? That we should keep 12% of preference share capital as closing balance. So 12%. The preference share issued capital is 13 lakhs. So I must keep aside 1,56,000. So this is your amount set. Now one by one appropriation I can subtract, like, so minus appropriations. What are my appropriations? First one, transfer 20% of the profit to reserve. So 20% of our current profit is 8,89,000 is transferred to reserve. 20% of 8,89,000 is 177,800. Then you declare preference dividend 14%. So 14% preference dividend. Paid up capital is 13 lakhs. On that 14% is 1,82,000. Then equity, of course, your equity dividend declared is 20%. Paid up capital is equity is 7 lakh, 20% of 7 lakh, so that will be 1,40,000. As soon as you decide to give 1,40,000 dividend to shareholders, equity shareholders, 10% of that will go for staff bonus. So fourth, provision for staff bonus. That will be how much? 10% of whatever you are going to give to equity people, 1,40,000. So that is 14,000. Nothing else. Okay. When you subtract all this, your surplus profit remaining now is 299,200. And this 299,200 should be distributed 1/3 to preference shareholders, 2/3 to equity shareholders, and 10% of 2/3 to staff bonus. That is where students makes mistake. They find it very easy that, okay sir, where will go 299,200, 1/3 and 2/3. No, because whatever 2/3 you give to equity shareholders, you have to pay 10% of that to staff bonus. So this 299,200 has to be distributed, one for preference dividend, then for equity dividend, and whatever is equity dividend, provision for staff bonus. Okay, come on, look at the calculation part. You can assume anything, preference and equity, 1/3 and 2/3, 1:2. I presume, let this preference is 100, assumed. So this has to be 200, and this will be 10% of 200, so that will be 20, right? So 1 is 100, 200 and 20. In that ratio, you will distribute 2,99,200. I can easily say like 10 is to 20 is to 2. Further simplification is also possible, like you can say 5 is to 10 is to 1, but ultimately all are job of calculator, friends. Okay, come on, use calc. Distribute 299,200. So this particular part, preference dividend, equity dividend, and 10% of that staff bonus you will get. How much? So this figure will be 93,500. This is double of 93,500, 1,87,000, and this will be 10%, 18,700. Distribution of profit. In fact, distribution of surplus profit among preference shareholders, equity shareholders, and 10% of equity shareholder to staff. That was a typical sum, repeated twice or thrice asked by ICI in the past. We now take full length sum discussions where a trial balance is given, adjustments are given, and you have to prepare Schedule 3, face of balance sheet, face of P&L statement, and notes to accounts. A very important points to be noted down by you here is, for your exams, Accounting Standard 4, AS4, has given a specific change regarding dividend declared by the company. Previously it was words like proposed dividend, then the word came dividend paid, then the word came dividend declared. For your attempt, if the word comes is dividend declared, what care to be taken is there on your screen. The final dividend is not recognized as a liability. This cannot be recorded as a liability at balance sheet date, even if it is declared after reporting date but before approval of financial statement, as per AS4. Hence, it has not been recognized in financial statement. Means it cannot be recorded in financial statement. Such dividend will be disclosed in notes only. Notes means as a footnote. You can write the dividend declared is of this much amount. No effect of that should come in final account. Okay. Your first job is always reading the trial balance, classifying the trial balance, and classifying the adjustment. Like, say for example, this question: Question number 1 in your textbook. Following is the trial balance of Shubhas Limited as on 31st March 17, and figures are rupees in thousands. Now when you classify them, first, land at cost is a tangible asset. Plant and machinery, also tangible asset. Debtors will come under the head trade receivables. Capital work in progress has its own head. There is no note for that. On the face of the balance sheet, there is a separate item under non-current asset, property, plant and equipment. Capital work in progress, so it will be directly on the face of the balance sheet. Bank is cash and cash equivalents. Purchases will go to P&L, purchase of stock in trade. Factory expenses are other expenses, administration expense also, other expenses, selling expense also, other expenses. Opening stock is changes in inventory, where we write opening stock minus closing stock. An interim dividend paid is an appropriation that should be subtracted from surplus. Surplus which you write in note 2. Opening balance of P&L plus net profit or loss for the current period. From that, subtracting dividend. So that will be minus from surplus, means less from P&L account. Then the credit side, equity share capital is share capital. This will be share capital. 10% debentures is long-term borrowings. Whenever you have any item in the trial balance with 10% right from 11th standard, you have that habit. That will be indicating some hidden adjustment for interest. On 100, 10%, of course. So outstanding interest on debentures will be 10. Outstanding interest on debenture is a hidden adjustment. Two effects. First, it's an expenditure. It is finance cost, and second will be going to other current liabilities. Next, general reserve is reserves and surplus. Profit and loss account is opening balance of P&L under the head reserves and surplus. Security premium, reserves and surplus. Sales will be on the face of P&L as revenue from operation. Creditors are trade payables. Provision for depreciation will be deducted from tangible assets, and you cannot have a classification of suspense account. That will be mentioned in the adjustment as to what is the suspense standing for. During the year, company issued a bonus share to shareholders on 1:3 basis. No entry relating to this has been passed. So when you give effect of bonus, first effect add to share capital, and second effect is fully paid bonus shares issued, section 63 of the Companies Act, less from reserves and surplus. If you remember section 63, the order of using reserve, first has to be capital redemption reserve, second capital reserve, third securities premium, and last the free reserves divisible profits. Okay. Authorized share capital of the company is only additional disclosure going to share capital head. This will have two effects, add to share capital, and second effect will be less from reserves and surplus. Company on the advice of independent valuer wish to revalue land at 1,80,000. What is our trial balance value of land? 110. So tick mark. It's now revalued at 180. So two effects. First, add in 1,10,000. So add in tangible assets. And second, it will create a revaluation reserve of 70,000. That will be revaluation reserve going to reserves and surplus. Declared dividend 10%, I just shown you, no effect, only footnote. Provision for taxation at 40% will be the last calculation after making P&L statement. Provision for taxation will be short-term provisions, and then on the face of P&L it is point number 10, tax expenses. In that it will be current year's tax. Suspense account of 2000 represents cash received. So 2000 is amount received for sale of some of the machinery on 1/4/16. Our year end is 31st March 17. So we are selling machinery on the very first day of the current year. So 2000 is selling price, amount received by you for sale of machinery. The cost of machinery was 5000, and the accumulated depreciation, the PFD, provision for depreciation, is 4000. So cost 5000 minus provision 4000. What does this mean? 1000 is your WDV. And a machine whose WDV is 1000 is sold for 2000. That means there is a profit on sale of rupees 1000, which is an exceptional item. How it will affect our solution, students? First thing, the cost 5000 of the machinery will be deducted from the cost of machinery. So from 3,85,000 minus 5000. 4000 PFD, provision for depreciation, accumulated depreciation, will be deducted from 86,000. This suspense account will now be nullified. It will not affect our solution because that suspense 2000 was cash received, whose net effect we are giving now. So first effect, less from cost, second effect, less from provision, and last effect 1000 profit on sale of machinery. That will go to definitely our exceptional items. Depreciation is to be provided on plant and machinery at 10% on cost. This depreciation will have two effects. One is depreciation and amortization expense in P&L, and second effect will be it will be added in PFD. 10% on cost. Your original cost was 3,85,000 minus 5,000 for the assets sold. So cost now left will be 3,80,000, and on that 10%. So your depreciation of current year will be 38,000. Of course, while writing the solution, you are writing in thousands. It will be 38 depreciation of current year. Closing stock is 30,000. First effect, it will be inventories, and second effect will be change in inventories. Change in inventories, opening stock minus closing stock. You are required to prepare Subhash Limited's profit and loss account for the year ended 31st March and balance sheet, a full length format, and you have to proceed with the solution here. Clear, all of you? So this is the way you should classify the full trial balance sum with adjustments. And once you write all effects properly, the rest job is to prepare the format and just like fill in the blanks, put them at appropriate places. That was discussion of question number 1, full and sum, having P&L as well as balance sheet. We take one more question on company account, a full and sum. Ring Limited was registered with a nominal capital of rupees 10 lakh. Students, nominal capital means authorized capital divided into shares of rupees 100 each. So number of shares will be 10,000. Following trial balance is extracted from books on 31st March 12. Building, machinery, closing stock. Now closing stock is given in the trial balance. That means the purchase given in the question must be adjusted purchases. Loose tools, look at that. Adjusted purchases, right? What do you mean by adjusted purchases? Purchases coming after adjusting opening stock and closing stock. So this is an important point of this sum. 4,20,000. Okay. Next, salaries, directors' fees, rent, depreciation, bad debts, investments, interest accrued on investment is our asset, receivable investment. Okay. Next, debenture interest, advance tax is advance income tax paid by the company, sundry expenses, debtors and bank balance. The credit figures are sales, then outstanding expenses. Outstanding expense in the credit is a liability, right friends? Next is provision for doubtful debts on 1/4/11. That will be a kind of our formula which you studied in 11th standard. Old provision, in fact old bad debt plus new bad debt plus new provision minus old provision. This is our old provision. Okay. Next, equity share capital, general reserve. Profit and loss on 1/4/11 is opening balance of P&L. That will go to reserves and surplus. Creditors, provision for depreciation, PFD is given on building and machinery. That means this building and machinery are nothing but the cost figures. Whenever provision for depreciation is given in trial balance, the concerned assets are always at cost. 14% debentures, interest on debentures accrued but not due. That is your liability, payable interest on debentures, interest on investments and unclaimed dividend. You are required to prepare statement of profit or loss for the year ending on 31st March 12. Balance sheet is as at that date after taking into consideration the following information. Closing stock is more than opening stock by 1,60,000. What does this mean, friends? My closing stock is how much here? Trial balance gives you closing stock is 180. Now closing stock is more than opening stock by what amount? It is by rupees 1,60,000. What does it mean, friends? That opening stock, closing stock is 1,60,000 more than opening stock. What does it mean? Your opening stock has to be how much? Your closing stock is given 1,80,000. This is difference of 160. That means my opening stock must have been 20,000 rupees, right? Continue. Next will be provide for doubtful debts. There is new provision. Make provision for income tax at 30%. Depreciation expense include. See, depreciation is already given in the trial balance, students. Here is 40,000. Means current year's depreciation is already charged. That 40,000 is consisting of 16,000 on building and 24,000 on machinery. Directors declared a dividend at 25%. Already taught to you, friends. Dividend declared will not come in our balance sheet. We have to write that footnote which I already taught you, right? That 4-5 lines footnote which is already taught in the previous sum. Transfer to general reserve 10%. 10% of what? It has to be 10% of net profits. Bills discounted but not yet matured 20,000. BR discounted and not yet matured means in future it may get dishonored, right? So it's a contingent liability for us. So this is a contingent liability. A simple sum, not much more difficult, students. Only care to be taken is about adjusted purchase given to you. What is my adjusted purchase? Adjusted purchase is 4,20,000. Adjusted purchase means opening stock plus actual purchase minus closing stock will give you adjusted purchase. So when you make changes, opening stock you already found out. Closing was 1,80,000. Opening is 160, right friends? And this 4,20,000. So that will be our item. So 20,000 opening stock plus purchase is missing minus closing stock 1,80,000 is equal to adjusted purchase 420. So when you make LHS RHS changes, you will get actual purchase, difference of 160, so 5,80,000 will be actual purchase. So when you write it in P&L statement, purchase of stock in trade, the amount will be 5,80,000 rupees for adjusted purchases or actual purchases. Nothing difficult in that. Okay, so two full length sums. One discussed previously, and this was question number 2. We have completed. Always when they ask you this kind of full length sum in exams, be very careful about your speed. So this will require face of balance sheet, then face of P&L, then notes to accounts. So we should see to it that there should not be much more on the part of time consumption on your side. Students does get the answer. They say, sir, we got it tallied, but if you got it tallied by consuming more time than requirement, that will kill your other questions, because at that time the time available with you will become less. Okay, so this question coming to an end. We take the another part for income tax, which is related for the company final account. It is regarding assessment completion of the limited company. Yours is a company. Income tax, you learn it very well, friends. You earn income in the previous year and assessment is done in the next year. All companies, they pay advance tax as well as they keep provision for taxation for every year. 1 year advance tax, for that year you keep provision for taxation. Assessment is done in the next year normally. So assessing officer will demand from you, will raise a demand of income tax from you in the next year. This demand raised by the assessing officer from you, from your company, we can call it as either gross demand of income tax, or you can call it as liability for taxation. Some people call it as income tax liability. Meaning is after all same, friends. Okay. We proceed with understanding of that thing. A question can be asked on to you, because question number 3 of our textbook is on that point, where you have to understand journal entries, and on basis of journal entries you have to prepare 3 ledger accounts: advance tax account, provision for taxation account, and liability for taxation. Liability for taxation also called as gross demand of taxation. Both are meaning same. Don't forget, advance tax and provision for taxation, both are personal accounts. So when you start with the ledger accounts, at that time their opening balance must come. Advance tax is an asset, so it will have a debit balance, right? Provision for taxation is a liability, so it will have a credit balance. So that thing you have to take care while doing posting. First you show the opening balance, then pass journal entries, or think of the journal entry and make the posting. What procedure you have to follow? I am just first going through the question which is given in your textbook. Question number 3. Trial balance of Complex Limited as at 31st March 15. So our current year is 31st March 15. Current year is 31st March 15 means you are talking about previous year 14-15. Okay. Previous year is a year word in terms of income tax subject. Shows the following items: advance payment of tax 2,20,000 and provision for taxation for the year ended 31st March 14, that is last year's provision. So this is 12,000 is provision for the previous year 13-14, which will come as an opening balance in provision account, credit side as by balance brought down. Following further information are given. Advance payment of income tax includes 1,40,000 for 13-14. So out of 2,20,000, 1,40,000 is for the last year 13-14. That means remaining 80,000 tax you paid for the current year 14-15. Actual tax liability for 2013-14 means last year's assessment must have been done in current year 13-14 amounts to 1,52,000, and no effect for the same has so far been given in accounts. So assessment is already been done and we have not yet given effect of the assessment. Provision for income tax has to be made for 2014-15 for 1,60,000. That is provision for the current year has to be made by you. You are required to prepare provision for income tax account, advance payment of income tax account and liability for taxation account. So we now try to see how you proceed with it. I am showing you a complete detail of the discussions which can take place on this adjustment. Do remember it properly. Accordingly pass your entry and make the postings. Not to forget, advance tax account will have an opening balance in this sum of rupees 1,40,000 and provision for taxation will have an opening balance of 1,20,000. Okay, let us start with the discussion of the theory part of how do you proceed with this kind of sum. Current year is 14-15, assessment is done of last year 13-14. I try to teach you the basics of that adjustment where you have assessment done of the company, what steps to be taken care of by you. Reminding you again, assessment in the current year has to be done of the previous year. So what comparison will take place? See, trial balance will give you advance tax of past year whose assessment is done, provision for taxation of past year. An adjustment will tell you that for that year assessment is done and for the assessment this much amount of income tax liability is demanded by the assessing officer. Following steps are required. Adjustment for gross demand of income tax, liability for tax. Step 1. The year for which adjustment is given, like in our sum it was 13-14. For gross demand of income tax, all trial balance item for that year should be ignored and cancelled. So, first step, assessment is given for the year 13-14, right friends? So 13-14 items of trial balance should be ignored. Here it is. 1,20,000 provision for taxation will be ignored and 1,40,000 that will be ignored. Means there will not be any journal entries for that. They will simply appear as opening balance. They will not have any direct impact on your balance sheet or P&L. Second, in the working note we have to compare gross demand of the adjustment. Gross demand means liability for taxation of the adjustment with advance tax plus TDS. In our sum TDS is not given, but suppose they have given TDS, then that TDS of that year given in the trial balance, which is ignored by us. Just now I cancelled you. So we have to compare trial balance advance tax with adjustment gross liability. First comparison. Second comparison, trial balance provision for taxation with adjustment gross demand, that is liability for taxation. This comparison will result into following. First comparison, the comparison of advance tax plus TDS with gross demand, that is income tax liability. Case A, if advance tax plus TDS given in the trial balance is more than gross demand, means our company has paid already more tax than what is demanded by the assessing officer. The difference is called income tax refundable. Say we already paid advance tax of 1 lakh and gross liability is 90,000. So definitely 10,000 will be income tax refundable, which will appear as a current asset in the balance sheet. So if advance tax is more than gross demand, what it will result into is income tax refundable, which is a current asset. Second case, if it is less, if advance tax plus TDS is less than gross demand, difference is called as outstanding tax. So if suppose advance tax paid by us is 1 lakh and assessing officer is demanding 1,10,000, so we still have to pay 10,000, that is outstanding tax. So if advance tax is less than gross demand, difference is called as outstanding tax, which appears as a current liability. Okay, look into our question. How much was advance tax? 1,40,000. How much is income tax liability? 152. So clearly our advance tax, we are in this case, advance tax 1,40,000 is less than income tax liability 1,52,000. So 12,000 will appear as current liability, named as outstanding tax in our sum. The next comparison, we have to do compare provision for taxation of the trial balance with gross demand of adjustment. It will result into following. Case A, if provision for taxation is more than gross demand given in the adjustment, the difference is called excess provision. Say our provision is 2 lakh and income tax demanded is 1,70,000. So our provision is in excess by 30,000. So we call it as excess provision. So if provision for taxation given in the trial balance is less than gross demand, difference is called as short provision for taxation, which is deducted from point number 10 of P&L statement. You know it very well. P&L statement point number 10 is current tax. Its heading is tax expense. A is current tax, provision for taxation. B is deferred tax and C is excess provision or short provision. If your provision is in excess, so the tax expense will come down. It's a kind of a gain for us, savings for us. Next, if provision for taxation is more than gross demand, right? Both cases are available to you, short provision and excess provision. This is excess provision. Case B, if provision for taxation is less than gross demand, assessing officer has demanded 1 lakh tax from you and your provision kept is only 70,000 rupees. So we still have to create 30,000 more provision. So difference is called as short provision for taxation. And that short provision also will come under the same point, point number 10. But additional provision to be created. So to that extent, tax expense will go up. Okay. So that expense will be deducted from your profit. Look at the word. It will be deducted from point 10. This excess provision was added to profit in point 10. Points to remember. If adjustment says that assessment is done without any further liability to pay tax. See, in our question they have given you that tax liability is 1,50,000. But sometimes to twist you, what they will do is, they will say assessment for this year is completed with no further liability to pay tax. Now what do you mean by no further liability to pay tax? It means whatever advance tax we already paid, that is enough for us. So that is, in that case, without any further liability to pay tax, it will mean that gross demand of tax is same as advance tax. Second statement, if adjustment says that assessment is complete with no further provision required, that means whatever is our provision is enough provision. That means gross demand is equivalent to provision for taxation already kept by you. If adjustment says that assessment is complete with no further provision required, it means that gross demand of tax is same as provision for taxation. And last one, if adjustment says that gross demand of tax is disputed by company in income tax appeals, very much common, and you study that in income tax subject also. But if assessee is not satisfied with the assessment, what assessee will do is, he will refer it to income tax appellate tribunal. Our company was not satisfied with the assessment done by the assessing officer. So we moved to the income tax appeal. What does it mean? That now it is in dispute, and any liability in dispute is a contingent liability. Okay. is given, then it is a contingent liability. Then for your knowledge, journal entries are given so that it is useful to you while doing ledger posting. Journal entries for comparison of advance tax with gross demand of taxation. Liability for taxation, whatever word you say. Advance tax is debit in the trial balance. Now it is adjusted, so we have to credit it. So advance tax is credited. If TDS is given, TDS also will be credited. Right friends? What to debit is liability for taxation, gross liability. The comparison will either result into income tax refundable or outstanding tax, income tax payable. If it is income tax refundable, it's an asset. So asset will have a debit balance. If it is income tax payable, there is outstanding tax. Credit. Liabilities are credit, assets are debit. Second comparison was with provision for taxation. If provision for taxation is debit, trial balance it is credit. Now it is adjusted. So I will debit provision for taxation. That is adjusted with liability for tax. So to gross demand for taxation. Already told you whether you write gross demand or you write liability for taxation, meaning is same. When we compare with provision for taxation, the result is either excess provision or short provision. Excess provision will be credit, here is, and short provision will be debit. Clear? So do remember this particular statements and comparisons what is done by you. Highly useful. And yeah, this question has its own unique feature in itself. Totally different from all other questions. So do remember them carefully. If they ask you prepare 3 ledger accounts, then those ledger accounts you should be able to prepare it in a perfect way. Like say, I can just show it to you. Here is see. One is liability for taxation account, that is gross demand for tax. Second is advance tax account. And third, provision for taxation account. I told you, provision for taxation will have an opening credit balance. So when you start with provision for taxation, do write here by balance brought down. Advance tax will have a debit balance. So we have to write it here to balance brought down. Okay. So do consider this question as a very unique variety. Do remember all entries and the steps. Working note should be prepared in a perfect way in exams. Very easy when compared to full length sums, where you make one mistake, suppose in full length sum, it can spoil your full answer. Here, just prepare a perfect working note. Rest things will go in a very smooth way. So that solution coming to an end, the discussion for liability for taxation, assessment proceeding. How do we give effect of assessment done in final account of a company completed by us? Students, we take latest paper of July 21 of CA Inter for company accounts, where a question was asked on that. So I'm discussing that with you. So we get it done, discussed here. Solution you can very well see on ICA website for suggested answers. You can practice on it so that you can understand that yes, you are able to do it or not. Okay? Chalo. Question number 4. The following is a trial balance of H Limited as on 31st March 21. Equity share capital of 100 each, 5,006% preference shares of 100 each. Now if that's a trial balance given to you, and if you see at the bottom of the trial balance, what is asked to you in the question, last paragraph, you are required to prepare H Limited's balance sheet on 31st March 21 and statement of profit and loss with the notes to accounts for the year ended 31st March 21 as per Schedule 3 of the Companies Act 2013. Ignore previous year's figures, they have not given to you, and taxation also is to be ignored by you. Question 4. Following is a trial balance of H Limited as on 31st March 21. 20 marks question, see that, okay? Trial balance adjustments, and you to prepare face of balance sheet, face of P&L and notes to accounts. Equity share capital will go to share capital. 5,006% preference shares of 100 each, share capital. 9% debentures is long-term borrowing. On 4 lakh, 9%. So you have to remember about hidden adjustment, that total interest should be 36,000 rupees. General reserve is reserves and surplus, profit and loss of previous year, means opening balance of profit and loss account, that will go to reserves and surplus. Sales, trade payable, provision for depreciation on plant and machinery, that means plant and machinery is given at cost to you. Suspense account, even in our classwork sum there was a suspense account of 2,000, credit side if you remember, that was profit on sale of motor car, something like that here. Land at cost, plant and machinery at cost, opposite was provision for depreciation. Trade receivables, inventories on 31st March 20. Our year end is 31st March 21, so that is opening stock. Bank, adjusted purchase is given to you. So we have to find out the actual purchase. Factory expense is other expense, administration expense, other expense, selling expense is other expense, debenture interest, 36,000 clearly given is our finance cost. Goodwill is intangible asset. The authorized share capital of the company is 5,006% preference shares of 100 each, 10,000 equity shares of 100 each. Authorized capital is a disclosure requirement. Issued equity capital on 1st April 20 stood at rupees 7,20,000. Opening balance, that is 6,000 shares fully paid, 6,000 into 100, 6 lakhs, and 2,000 shares 60 paid, partly paid, means final call of 40 was pending at the beginning of the year on that particular category of share. Directors made a call of rupees 40 per share on 1st October 20. So during the year the call was made. If you see the trial balance gives you equity share capital 8,05,000 rupees. Opening balance was 7,20,000 rupees, right? Okay, continue. Directors made a call of 40 per share on 1st October. On 2,000 shares, 40 per share, so 80,000 rupees is called due. A shareholder could not pay, call on 100 shares, call scenarios on 100 shares, and his shares were then forfeited and reissued at 90 per share, fully paid. So indirect hint for you, there will be a generation of capital reserve. So in short, all shares are now fully paid for you, because if you see 100 shares were forfeited and then they were reissued, so there was no problem. All shares are fully paid now. Plus you will have an incurrence of capital reserve, that will go to reserves and surplus. On 31st March 21, directors declared a dividend of 5% on equity shares after transferring any amount that may be required from general reserve. Amount transferred to general reserve. Ignore taxation. That is there in your theory, transfer to general reserve provision. Company on the advice of independent valuer wished to revalue land at 36 lakh. What is value of land in the trial balance? 24 lakhs. New value is 36 lakhs. So value of land is going up by 12 lakhs. First effect, add to land, and second effect will be revaluation reserve going to reserves and surplus. Next, suspense account of 40,000 rupees represents amount received for the sale of some of the machinery on 1/4/20. 1/4/20 means we are selling at the beginning of the year. Cost of the machinery was rupees 1 lakh and accumulated depreciation thereon being 30,000. So cost 1 lakh. If you try to calculate this, friends, what it goes for is cost of the machinery which we are selling is rupees 1 lakh. The accumulated depreciation, you can say PFD, provision for depreciation on that, is 30,000. So 1 lakh minus 30,000. My WDV will be 70,000. Right, friends? And that 70,000, look into trial balance. Okay. Suspense account of 40,000, adjustment says, represents amount received. So WDV 70,000, selling price is 40,000. What does it mean, students? There is a loss on sale of rupees 30,000. Right? That loss on sale will be an exceptional item in your statement of P&L. A separate note will be prepared. Loss on sale of machinery. It will be negative, of course. Loss will be deducted from your P&L statement. Depreciation is to be provided on plant and machinery at 10% on cost. Means you are charging it by straight line method. Look into a trial balance. What is cost of plant and machinery? Your plant and machinery at cost is 770. Students, out of 770, we have already sold one machine whose cost was 1 lakh. So remaining cost is 6,70,000. On that you have to charge the depreciation. Amortize 1/5 of goodwill. Goodwill written off to the extent of 1/5. What is goodwill in the trial balance? 12,50,000. 1/5 is to be written off. First effect, less from goodwill. Goodwill will come under the head property, plant and equipment, intangible assets. In the second effect, amortization will go to depreciation and amortization expense. Okay, so that particular adjustment for you. This was adjustment for suspense. This is the reason. Okay, you are required to prepare H Limited's balance sheet as on 31st March 21 and a statement of profit and loss with notes to accounts for the year ended 31st March 21 as per Schedule 3 of the Companies Act 2013. Ignore previous year's figures and taxation. Clear, all of you? Okay, so that will be the question. I've discussed it with you. As a practice, you can solve it. As I told you, friends, answers are available on ICA website, suggested answers. You can match the answers with them. This can serve as an additional practice, like a test for you. And you can analyze that where you stand, how much you can do. Students, take one more care. This question is carrying 20 marks, right? A full length question it is, see, 20 marks question. So for 20 marks, you first try to see how much is allotted time. You can approximately count 108 seconds for 1 mark. For 1 mark, 108 seconds. So for 20 marks, it is 2160 seconds divided by 60. So 36 minutes is a standard time allotted to solve this sum. Count 40 if you overshoot by 4 minutes. Then in 40 minutes, including drawing of format, all postings, your balance sheet should tally. Only getting answer is not sufficient, students. Are you getting answer in the allotted time? That is more important. We shouldn't come out of the auditorium of exam saying that I was knowing it but I couldn't solve it because I didn't have time. That's a suicidal attempt. Suicidal attempt. A golden word goes, keep a watch on your watch. Keep a watch on your watch. The time limit for every sum should be set by you. I told you 108 seconds for 1 mark, approximately. See to it that you don't overshoot more, because overshooting more in any of the sums will definitely lead to sacrifice of any other question in future. And that becomes a suicidal attempt, students. Okay, so that was the paper of latest one, July CA Inter 2021. We solved one more sum. That was for CA Inter January 21 paper. January 21 for those opt-out students of November 20, where ICI given that facility for opt-out due to COVID-19. Read that question. In that, it was question number 6B. The paper code on your screen is there, HPR, question number 6B. Here it is on your screen. Following is a draft profit and loss account of Brown Limited for the year ended on 31st March 20. Amount. Credit side is buy balance brought down. There is opening balance of P&L. Buy balance transferred from trading account is nothing but the gross profit, which is the starting point of our calculation. Subsidy received from government, yes, it will be taken up. And profit on sale of forfeited shares. No, profit on sale of forfeited shares is nothing but capital reserve. That cannot be taken. Look at the debit side. Administrative expenses, advertisement, commission on sales, director's fees, interest on debentures. Managerial remuneration cannot be taken, friends, because that is what we are calculating. Depreciation on fixed assets, acceptable if it is as per Schedule 2, Section 123. If not, it cannot be accepted. Provision for taxation cannot be taken. All provisions, all reserves are ignored for Section 198 of the Companies Act. General reserve, no. Investment revaluation reserve, no. To balance brought down is of no use to you. Depreciation on fixed assets as per Schedule 2 of the Companies Act 2013 was 515675. Look into your P&L account. How much was depreciation you charged? Depreciation charge was 482565. So that 482565 we cannot deduct. Our deduction has to be as per the Companies Act, Schedule 2 precisely. You are required to calculate maximum limit of managerial remuneration as per Companies Act 2013. So, Section 198 calculation first of all, that is calculation of managerial remuneration, and then we have to find out after finding the profit that how much remuneration it can be given. The total remuneration is our students, so maximum is 11%. Okay. So if you see a rough calculation, friends, I'm showing you a rough calculation to you as to how it can go for. You will start with the gross profit. Okay. So GP. Here in your question, the word used for GP is balance from trading account. That amount is 3815890. Then credit side, yes, subsidy received from government will be added. So add subsidies received from government. So my total will be 4065890 minus all expenses in the debit. First one is administrative expense. Yes, it's a regular routine expense. Amount is 499,200. Second, advertisement. Yes, selling and distribution expense 118,200. Third, commission on sales. Yes, that is also selling and distribution expense. Commission amount is 95,225. Director's fees 135940. Yes, has to be deducted. I taught you the director fees are not a part of director's remuneration. 135,940. Next, interest on debenture. Yes, finance cost. That is 28460. Managerial remuneration you can't deduct because that is what we are calculating. Depreciation on fixed assets you cannot because that is wrong. It's not in coinciding with Schedule 2 of the Companies Act. Rest all are provisions and reserve, we cannot. So now lastly I'll discuss from your additional information depreciation as per section 123 or Schedule 2. How much? 515675. Total of all this is 1392700. And when I subtract it, it is 2673. 190. This is your net profit for managerial remuneration purpose. Net profit under section 198 for managerial remuneration. And on this 2673190, what is maximum allowed to you? 11%. So as per section 197, maximum permissible managerial remuneration will be 2673190. The 11% of that is the maximum remuneration. 11% is approx rupees 294,051. Why I am using the word approx? Because it is rounded off figure. The paisas has been ignored and you know it very well. Ignoring paisas is by convention of materiality that you all know very well. So this is your answer for the paper of January 21 CA Inter. Question carrying weightage of 5 marks exclusively on managerial remuneration section 197 and 198. We take one more question which is very frequently asked by COI. Similar type of question. A question where only balance sheet is to be prepared by you. P&L is already prepared. Question will give you the net profit. Only balance sheet and notes to accounts related to balance sheet. The basic purpose of this question is to test whether you are able to remember all additional disclosures. You know it very well, friends. Schedule 3, multiple additional disclosure. Example, share capital. Additional disclosure number 1 is authorized capital. Less calls in arrears to be classified separately from directors and from officers. Number of shares issued for consideration other than cash. Number of shares issued as bonus. Number of shares bought back, buyback. 5 disclosures are only in the first head itself. Debtors to be classified in 2 parts. Outstanding for more than 6 months and other debts. When you show long-term borrowing, a secured loan, you have to show the security into bracket. So many disclosures. So this question is basically meant to test your knowledge that you are able to tally balance sheet with all disclosures Or there is always a short-term objective of many students. Oh, my God, balance sheet got tallied. My balance sheet got tallied. I got full marks. No, by any means not. So let's classify this question thoroughly and discuss it properly. On 31st March 15, Boss and Son Limited provides to you following ledger balances after preparing its P&L account, clearly given after preparing its P&L account, right? What do you mean by after preparing its P&L account? The P&L part is already prepared by you. So what we have to go for is only balance sheet part. So word clearly given is after preparing balance sheet. Classification for our purpose of the trial balance. We take question 12 in your textbook. On 31st March 15, Boss and Son Limited provides to you following ledger balances after preparing, look at the word given, after preparing its profit and loss account. That means we just have to prepare a balance sheet for the year ended on 31st March 15. Just try to classify. Share capital, fully paid shares of tonnage is share capital. General reserve, reserves and surplus. Loan from State Finance Corporation secured by hypothecation of plant and machinery is long-term borrowing. Repayable within 1 year is 2 lakh. So out of total 10 lakh 50,000, long-term borrowing will be 8 lakh 50,000. And this 2 lakh repayable within 1 year is current maturities of long-term borrowing. And this current maturities of long-term borrowing, that goes to other current liabilities. Next, loans, unsecured, long-term is a long-term borrowing. Sundry creditors for goods and expenses is trade payable. Calls in advance, other current liabilities. Profit and loss is reserves and surplus. Provision for taxation is short-term provision. Dividend payable is other current liabilities. Of course, as for the latest provision, dividend payable will not come in trial balance, it will come in adjustment. This is an old paper, but the same paper pattern is being followed by ICM anytime. So if they write it in trial balance, we have to write it in other current liabilities, and same thing for provision for dividend distribution tax. Both will go to other current liabilities if at all they give it to you in the trial balance. Next, the assets, the debit balances. Calls in arrears is less from share capital. Now here I can just show you a technical error of paper setting here. This is one of the past paper of ICM. Now there is calls in arrears, students, and if you see the trial balance first figure, equity share capital, they have used the word fully paid shares. Now when you have calls in arrears, you cannot use the word fully paid. So the printing mistake here should be, it should be fully called shares, not fully paid shares. Okay. So calls in arrears will be less from share capital. Land is a tangible asset, building tangible, plant and machinery tangible, furniture and fixture also tangible assets. Stock of finished goods and raw material, this is closing stock, it will go to inventory. Sundry debtors is trade receivable. Short-term advances itself is short-term loans and advances. Cash in hand is cash and cash equivalents. Balance with bank is also cash and cash equivalents. Preliminary expenses are expenditure to be written off to P&L account. So that will be less from P&L account under the head reserves and surplus. Patents and trademark are intangible assets. Following additional information is also provided. Look at the word additional information. These are not adjustments. Why? Because P&L is already prepared. One effect must have already been given. These are all disclosure requirements. See the first one. 4,20,000 fully paid equity shares were allotted as consideration for land and building. So in share capital you will write into bracket out of above dash 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 shares. This many shares, 4,20,000 shares are issued for consideration other than cash. Cost of building, plant and furniture. This is the cost of this. That means the trial balance figures given, this building, plant and furniture, has to be the WDV, net block. Cost is given in additional information, WDV is given in the trial balance. Difference between them is accumulated depreciation, PFD, provision for depreciation. Sundry debtors of 3,80,000 are due for more than 6 months. There is an additional disclosure. Debtors under the head trade receivable will be classified in two categories: outstanding for more than 6 months and other debts. Next, amount of balance with bank includes 18,000 with a bank which is not a scheduled bank, and deposit of rupees 5 lakh are for a period of 9 months. This is additional disclosure. When you show balance with bank under the head cash and cash equivalent, to show these details in the inner column. Unsecured loan includes 2 lakh from a bank and 1 lakh from related parties. This is also additional disclosure. When you write under long term borrowing, unsecured loan, see in your trial balance how much is unsecured loan. Unsecured loan is 8,40,000. So how will you show it? Just for your, you will write here as unsecured loan, then adjustment saying this unsecured loan of 8,40,000 includes 2 lakh from a bank. So from bank, inner column you can show 2 lakhs. Then 1 lakh from related parties. Then from related parties, 1 lakh. And lastly, you can write from others. Come on, look into trial balance. What is your total unsecured loan in the trial balance? Is 840. So current year column, amount column will be 840. Previous year column is nil. And how much will be others? You can easily find 2 plus 1, 3 lakh. This is 540 from others to make the total 8,40,000. So this is the way you can show the disclosure, additional information. Right, students? You are not required to give previous year's figures. As such, they are not given in the question also. You are required to prepare balance sheet of company as on 31st March 15 as required under revised schedule 3 of the Companies Act 2013. On the ideal sum of ICI carrying weightage between 10 to 12 marks, where only balance sheet, notes to accounts and more focusing on additional disclosure. Thank you.